I'm Dave Kazarowski, instructor and content developer for the CFA curriculum at the Princeton Review. I have a BS in Finance and an MBA in Investment Management, as well as a CFA charter. I have worked in the industry as an equity research associate and a portfolio manager in a family office. I'm currently a professor of finance in the San Francisco Bay Area. For the Princeton Review, my areas of expertise are equities and portfolio management, as well as derivatives and fixed income.
To state the obvious, it's been a rough couple of years. The COVID pandemic has been tough on everybody, and although it's getting better, we're still not back to normal. One of the big mantras of the investments industry, summed up by a quote that I like from Benjamin Franklin, "Out of adversity comes opportunity." There were companies that got a lot of business in the pandemic. I'm sure you can name a few yourself: Zoom, Netflix, Peloton. They all saw big gains in their stock prices as a result. Now that we're slowly emerging from the lockdown, these stocks are falling back to earth. In hindsight, the stocks fell victim to this standard valuation bubble, just like we saw the tech bubble in 2001 and the housing bubble in 2008, only this is a smaller scale version of it. Bubbles are tricky to understand, especially when you're right in the middle of them. Right now, though, we have a very rare opportunity. This bubble is just ending, so we have the benefit of hindsight at the same time as the situation is still fresh in our minds. While we're in this short window of time, I'd like to take a look at just what happened in this bubble and see if we can learn to understand bubbles better and maybe develop some tools to predict them. First, let's take a look at exactly what happened. Here you can see stock charts from Yahoo Finance. The upper panel is Netflix, the lower panel is Etsy. These are from the middle of 2019 until just up to current March of 2022. These were two of the high-profile companies that benefited from the lockdown. I'm sure you can think of many others. I could go to Zoom, Peloton, DoorDash, Teladoc. I could go on and on. I'm focusing on just these two because they have long histories from before the lockdown and give the most data and allow for the best comparison. As you can see in early 2020, as the world went into lockdown, both stocks began to climb. This makes common sense in light of the company's business models. People were staying home, they watched more TV, they shopped more online. With Etsy, of course, the added advantage of shopping for masks online. When the lockdowns ended in the end of 2021, both stocks dropped back to earth in a hurry. When investors are smart, this isn't the way stocks are supposed to behave. We all knew the lockdown would be temporary, and sooner or later, both of these companies would return to the business as they had it before. So why such a big increase and such a big reversal? As the CFA curriculum teaches us, efficient market hypothesis dictates that stock prices adjust to new information as soon as that new information comes to light. As an extension of that thinking, a stock's valuation multiples are assumed to gravitate to a long-term average number. The stock price goes up and down as information emerges that the company has better or worse financial results, but the ratio of the stock price to those financial results should stay about the same over time. You can see here the price-to-earnings ratio of the S&P 500 index since inception. Last couple of decades have been volatile, and you might have to squint a little bit to see the trend, but the PE has generally hovered around the high teens for its entire history. That is in line with efficient market hypothesis. These valuation ratios are supposed to stay put unless the company undergoes a permanent change to its operations. For instance, when Netflix switched from offering DVDs by mail to internet streaming, it became a different kind of company that commanded a different price multiple. In this case, when the lockdown began, we all knew companies like Netflix and Etsy would benefit. The prices of these stocks could be expected to increase according to our best estimate of the company's predicted results. Over time, the estimates changed as to how long the lockdown would last and how much money the companies would make from it. But here's the crucial point. It was all temporary. Temporary elevated earnings should boost the stock price, but the valuation multiples should stay the same because there was no fundamental change within the companies. With that said, let's dig into what the multiples of these companies looked like before, during, and after the lockdown. I'm using the price to sales ratio rather than price to earnings for both of these, since they're both early stage growth companies that have low earnings and the price to sales really doesn't look right, doesn't give us a good analysis. As you can see, both companies had elevated revenue and earnings in 2020 and 2021. Those are the years that most concern us because those are the lockdown. So no surprise with that. For both companies, the 2022 forward estimates show a decline with moderated revenue growth and declines in earnings. Also to be expected, as the lockdowns ended, the companies stopped benefiting from the extra business. The really interesting part here is the bar chart below that shows the price to sales multiple over time. Again, a temporary change in the business shouldn't prompt a meaningful change in the multiples. They should stay the same. As the company did more sales, the price should rise, but the price to sales should not. In the chart, you can see that the multiples did indeed go up during the lockdown and then drop back down in 2022 for the estimates. This suggests that investors were bidding up the stocks beyond what a reasonable investor would think was warranted. They were assigning it a higher multiple when it should only have had a higher price according to the same multiple. It also shows that those investors eventually changed their minds and brought the multiples back down to their historical average. Let's dig even deeper on this and take a look at the consensus estimates that Wall Street analysts attach to these companies through the lockdown and through their upturn. I'm going to use Netflix alone for this because it's the largest and highest profile company of the group and it has the most analyst coverage. As the lockdown dragged on, Netflix started to put up some great results. In the 2 years of 2020 and 2021, the company added over 50 million worldwide subscribers and increased its total subscriber base by a third. Wall Street analysts warmed up to the company and got more and more optimistic with their estimates. You can see on this table, this is a little hard to understand. Let me describe this to you. So the stated guidance that Netflix had is next quarter's estimated subscriber adds. Before they would release the next quarter's guidance for their subscriber adds, Wall Street would estimate what they thought that guidance would be. So we're looking 1 quarter ahead here. And as you can see, especially in the latter half of the lockdown in 2021, the consensus estimate of guidance outstripped the actual guidance most of the quarters, with the one exception being Q4 of 2021. This was especially bad in Q1 of 2022 that just recently came out and caused Netflix to lose a lot of value in its stock price. So you can see that the street repeatedly overestimated guidance, especially toward the end. Once again, everyone knew that the lockdown would end. It was just a question of when. What this suggests is that the analysts weren't thinking about when it would end and were just extrapolating the trend to keep going and going. And eventually Netflix would have to disappoint on its actual guidance, and the stock would take a big hit as a result. So this suggests that investors either underestimated the length of the lockdown or just kept thinking the party would keep going, extrapolated the trend, and were surprised when the punch bowl got taken away. Okay, that was a lot of numerical detail. Let's shake off the numbers and wrap it up by asking, so what does this mean? What can we learn from all this? How can we use this information? Well, I think there are a few takeaways that we can get out of this that we can use to save ourselves some money and some trouble for the next bubble. First of all, we see that in this bubble, prices rose and valuation multiples rose. Valuation multiples should not have risen because nothing fundamental within the companies happened. Everything stayed the same. And so when the bubble burst, those baseline multiples that existed before the bubble came right back down to become the crucial measure that they were before. This was the case with a lot of bubbles that I've seen in my career, with the tech bubble of 2001, for instance. When the dust settled in that bubble, the companies went right back to the valuation that was the baseline of their fundamentals. I should add the caveat that every bubble is different. Some bubbles, like the 2001 tech bubble, were triggered by innovations that do create value and change valuations in ways we can't predict, even though the traditional conventions of how to choose those valuation metrics and how we use them, all of that still applies. So you can continue to lean on that. Another big takeaway that I think we can get out of this is that we can't necessarily trust the professionals. We saw that the Netflix subscriber ads analysis suggested Wall Street kept on thinking that the trend was going to keep going and either underestimated or didn't pay attention to the end of the party. So when the conditions came back to normal, there was a big disappointment and a big loss of value in the price. As a former Wall Street analyst, I can attest to the idea that consensus estimates are more likely to ride a trend higher than try to call a turn. So we should be careful about trusting the supposed experts. And as we knew already, doing your own homework is absolutely the priority. And finally, I think the best piece of advice in all of this is keep your head. You may see a bubble happening and see a lot of people making money, and it could instill in you a severe case of FOMO. Arguments like "this time it's different" can sound compelling and try to pull you in the direction that you're dying to go just to make all the money that everyone else is making. But remember, bubbles burst and a lot of money gets lost just as quickly as it gets made. That's not the kind of horse you want to ride. And so understanding the fundamentals and keeping an eye on the basic rules of investing that we already know is your best bet.
I hope this gets you thinking a little bit about what we just went through with COVID and with this bubble as to what you saw and maybe whether you can recognize it the next time a bubble happens, as it inevitably will. It's my philosophy that it's best to learn from these experiences when they're fresh in your mind. And since we just went through this, we have a really a rare opportunity right now to take some lessons out of it. Generally speaking, the investment community doesn't learn from its mistakes. And so any kind of learning that you can get from this will put you that much ahead in the future.